I want to play a little bit with Am I Diversified? And we're running up at about an hour. We'll go for a few more minutes, leave the floor open for questions, and then release everybody to their Saturday. There's probably anybody here that's not familiar with Am I Diversified on CNBC's Kramer, the show that's on every weeknight. And I just want to propose an interesting thought. Basically, for those of you that are not familiar with it, a caller will call in and name 5 ticker symbols pretty quick, and what they do is they literally pull up the logo for the company and display it on a screen, and then Kramer does his own version of my Madden with his highlighter, and he'll just literally say, okay, well, Ford and Toyota, they're in the same industry, so not so diversified. These guys are not exactly in the same thing, but pretty closely related. Love Exelon, one of his favorite utilities. I'm not sure about it myself, but he basically goes through it and says, okay, fairly well diversified, but some of these companies are in fairly similar industries, and then he'll kick out, go get some GE and some Oracle and sell one of the car companies, and then you'll be fine. Well, I think everybody here knows that that's kind of weak. That's not all that we need to think about when it comes to diversification, and I know that you can't do it with 5 anyhow. You need basically at least 8, and most people think at least 12. Some people think even more than that before you can even really talk about am I diversified. But that's not what I want to focus in on. I want to focus in on what we know as a community, that there's one other component besides making sure the companies are from different sectors and industries and spreading it out. But we know that, in fact, I put the tag urgent on it because of this graphic. This is one that we also covered on Thursday night. Taking a look at this graphic, if this doesn't convince you, nothing will. Most of us in this community know this. We're looking at a 20-year chart. Of the one down here at the bottom is the S&P 500. Those are all very large companies. The blue area, there's the lost decade. The blue area has gone nowhere for the last 10 years or so. And if you were invested completely in the S&P 500 for the last 10 years, and by the way, if you were in an S&P 500 index fund for the last 10 years, you may no longer be an investor. So index investing is not the complete answer to this. Over the very, very long term, maybe if you're a very young person, but for somebody who sees more opportunity on the planet than that, it's not always the answer. And certainly not a single one invested in just one real category of stock, that being very large companies. I think all of us here like the red line. The red line is the value line arithmetic average, the value line arithmetic average. And we refer to this as all of the above investing because there are some small, medium, and large companies. In fact, all of the S&P 500 are in it too. We know that it makes all the sense in the world to invest in all of the above. Get yourself some small, rapidly growing companies, some medium-sized workhorses, and yes, when these guys go on sale, and some of them will, I mean, they've been stuck in the mud for 10 years, some of these are going to get really attractive. They already have started, right? Coming up out of the Great Recession, some of those will remain quite attractive. But here's the bottom line. Investing in the S&P 500 over the last 20 years returned 7% a year. And all the above investing, as evidenced by the value line arithmetic average, gave you this. So that's a absolutely huge performance advantage, and it should be enough reason for most of us and most of you to convince fellow club partners that you got to have some small companies. Discover promising, exciting small companies, sometimes in your backyard even, to take advantage of and experience to stay on the red line instead of the blue area, because I think all of us prefer this to what we see down below. So this is a very important aspect of diversification. At Manifest Investing, we urge that you keep track of the overall sales growth rate of the portfolio. So in the case of the 5 stocks called into Kramer, Ford, Toyota, Exelon, Baxter, and Medtronic, I mean, they're all in the blue, big blue company pie chart, so they're obviously not diversified from that standpoint, and the overall portfolio growth rate of those 5 companies would be 3.8. So even if they were from 5 different industries and you still had this 3.8, I would do a handstand with Mr. Kramer and say, they ain't diversified. So what I would invite somebody in the audience to do is to grab 5 companies, 5 of your favorite tickers, and let's just kind of go through a quick demonstration for Mr. Kramer of how easy it would be to do this for a show. And in this case, let's go ahead and jump out. Anybody use your ticker tab, or if you want to be unmuted to offer 5 tickers, just let me know. We'll create a dashboard and show how easy it is to do this stuff. So I'll wait for somebody to give me 5 tickers. We have multiple submissions from people, I suppose. Just what I need, another dashboard. I'll take the first 5 tickers I get. Here's an added dashboard. We'll call it Am I Diversified? And then to show you how simple it would be, we're going to put $100 into each one of the ones that come across the transom. Here's IPGP coming in from Mike. Calavo Growth coming in from Julie. We've got Mygenics, and then we'll stop with the first 5 we get, and then we'll play with it. Submit them. And as usual, you guys come up with a pretty interesting list. High quality, some opportunity perhaps in these 2, the Calavo and Myriad, but we have a much better situation in terms of growth. Again, the recommendation from our community is to aim for at least 10, if not 12% for your overall portfolio growth. You can see they're evenly divided here, but now we've got a situation where you can instantly point out, well, it is diversified. You got 4 different sectors. We'll take a look at industries here in a second. And, you know, you guys just heard that story, so you may have been a little bit biased. You picked 4 out of the 5 were relatively small companies with more rapid growth rates. So again, you might be leaning a little bit too hard on the faster growing or smaller company side. Understandably, we know that that's where there's exciting long-term opportunity. Obviously, there's danger there also, but this portfolio is much more diversified. So I'll slap those 5 logos up there. Better sector diversification. Which 2 are from the same sector? There's 2 technology stocks here. And the 2 technology stocks are going to be Synaptics and IP Photonics. Let's go ahead and swap out IP Photonics and replace that with something a little larger. Did you guys give me any large companies? Somebody give me a large company. We'll take Schlumberger. So $100 into Schlumberger. Come back to the portfolio. Now we really have gone for 5 different sectors. Schlumberger, great company. And actually slowed down the growth a little bit, but it's a more medium-sized company, so we've split this up a little bit better. So we don't have any of those giant monsters in the S&P 500 in there. But let's go ahead and just demonstrate how, let's throw 5 more tickers at it. Pretty easy to do, guys. And let's go ahead and throw another 5 at it and see how the diversification holds up. We're going to put $100 into GE. What else you guys want to throw into the mix? Fresh Market came up the other night. Let's throw that one in there. LKQ, I hate the company too much to put that one in. Sorry, Ruth. SodaStream, that showed up in the heavy hogs. I'm going to put Toyota Motor in there because that showed up at the top of the S&P nudge list for this weekend. And Linda Hunt, God bless you, offers up Stryker, good Michigan company. We still need your help out there. Okay, so now we've got 10 companies, still well diversified when it comes to sector. Jumped into a couple more staples, that's okay. But now you can see that with 10 companies, again, you're in more of a diversified situation. You have some large, some medium, some small, again, biased by some of our more recent comments. But now the overall growth rate of the portfolio is nicely balanced in around 11%. You can have a Toyota and you can have a General Electric so long as you also have some SodaStreams and some Fresh Markets in your portfolios. It's all about balance. And this is what I want to share with Jim. And I just think this could be an interesting new feature that would demonstrate an extremely important concept to investors. Kramer, love him or hate him, I happen to like him a lot. I mean, I watched the program for some interesting ideas. I think when he calms down and sticks to some of his analysis and industry studies and that kind of stuff, it's perfectly fine viewing. And he's really does. He's a closet investment club community member. If you listen to some of the stuff he talks about, especially when he's not throwing furniture, and even more importantly, if you take a look at their Action Alerts model portfolio, they behave like us in a lot of ways. Between him and Stephanie, a lot of the core holding stuff is evident in that portfolio. So that's why we have him as an honorary guest groundhog every year in our competition. Again, important stuff. Make sure that you keep an emphasis on the smaller companies, and I think it's an extremely important diversification concept that we all need to really pay attention to.